now we are going to pivot to our third talk of this morning. Starting off again, as you all know, I'm Nasba Rosado, and I want to welcome you all here, and I want to ensure that we are consistently thanking Suffolk University for hosting us this year as well as last year. Because it's just such a great venue. I also want to call your attention to the fact that this is the 8th annual Startup Week, the Startup Boston Week, and it is such a great event. So I'm so happy that you've all joined us. And I want to also mention that this particular session is being sponsored by Fidelity. So with that, I'm going to turn it over to our moderator. You have a wonderful panel ahead of you today. So Kristen, you can take it from here.
Awesome. Thanks so much, Nazma. So really wonderful to have you here. And I know there's a bunch of folks joining us on live stream. Really excited to dig into this topic. In my opinion, this topic of being prepared to fundraise, making sure your cap table is in order is super important. And the reason I think it's so important is because it is a slightly more sluggish fundraising environment right now than in a few years ago, let's say. And founders are increasingly finding that being prepared is oftentimes the differentiator between having a successful fundraise and not having a successful fundraise, between going through due diligence easily versus having that due diligence process drag out. So I'm honored to be joined by 3 dear friends and experts in this topic. I'm going to let each of them introduce themselves in just a moment. But before I do, my own background is entirely in the startup world. I started a company myself coming out of undergrad, ran the business for a few years before going to business school at MIT, and then spent the next decade in startups as an operator while also doing a lot of angel investing and advising. So this topic is near and dear to my heart, and God knows I made a ton of mistakes along the way. So I'm excited to help others hopefully avoid some of those mistakes and learn from pros such as these about how to do this right. So Ellen, do you want to introduce yourself?
Sure. Hi, everyone here in the room and joining us online. I'm Ellen Shiza. I'm a partner at Boldstart Ventures. At Boldstart, we're backing enterprise founders from their earliest days. So like Kristen, I'm often talking to people about getting their cap table to the right place right after they start thinking about incorporating. And I agree, this is a super important topic and excited to have all of our perspectives here.
Hi, everyone here and online. I'm Richard Rabat. I'm the founder and CEO of Lighty AI, which is the second startup that I started. I've been in tech most of my career and excited about like the work that we're doing, but also, always concerned about like how the fundraising environment is. 6 months ago it was bad. Like now it sounds great. And every 6 months you have to be worried and prepared for something new. So excited to be part of this panel.
Hi all, Mike Jabawi, partner at Morse. We're a corporate law firm, 50 attorneys, and serve the Boston and tech and VC community as an alternative to going with larger firm. We've got the specialties to support those businesses, and I also do a lot on the investor side. I do about 60 to 80 financings a year with a very small team, so we like to think that we have our finger on the pulse of what is market.
Awesome. And just one sort of flow comment. Please, if anybody has questions throughout, I know we do have some time at the end for Q&A, but if you have questions about anything that we're talking about, please feel free to raise a hand. Happy to jump in and clarify anything or go deeper on any topic if anybody wants to know more about something that one of our amazing panelists touch on. So let's start with a little bit about the fundraising climate. Late 2020, early 2021 was sort of gangbusters. Then we had a slowdown in funding. Now things are really picking back up, which is so exciting to see. On a personal level, sorry for any New Yorkers in the room or on live stream, but I was delighted to see actually that last year early stage fundraising in Boston was number 2 in the country, second only to San Francisco. So my personal opinion is that what we are seeing here is such a testament to the raw intellectual horsepower that exists exists in Boston, as well as the incredible companies that people are building. I would love to let all of our panelists share their observations firsthand on this fundraising climate, and especially around early stage fundraising. So, Ellen, given that this is where you focus with Bold Start, will you share your observations on the fundraising climate?
Yeah, definitely what we've been seeing, as Kristen was saying, in 2020 and 2021, there was a lot of funding across every stage of startups, in large part due to the low interest rates at the time. Venture was a great place for people to be allocating dollars in their portfolio. One of the things we've seen as public market multiples have come down is that we're seeing a lot more energy from LPs, from venture towards backing companies at the earliest stages. And so that's what I'm doing as well. But we're seeing a lot of momentum going into the pre-seed and the seed market. I think that's definitely reflected in Boston. We have a lot of great funds here in that space. And I think, like Richard was saying, we're also sort of seeing some of that momentum come back at the later stages, but that really comes with a lot of discipline around metrics as well.
Awesome, thank you. And Richard, I know that you've been in conversations with investors yourself recently. What have you observed being on the founder side vis-a-vis the fundraising climate?
So I would say, like, we did the pre-seed early last year, and it went very, very fast. Like, in a couple of weeks, we had closed our pre-seed and we were just building the product. And then toward the end of last year, we were thinking about, like, doing another raise, and then it was basically very quiet. And so we decided to continue building and continue, like, working on the product and, like, what Ellen was talking about, like, working on the metrics, making sure that, like, we have proper pilots, we have people, payers, all these pieces that, like, make it that we have a strong survivable business. And towards the end of this summer, we started, like, seeing, like, more inbound from investors, and Ellen's, knows why, but, like, we've seen, like, much more interest from investors, and we've had, like, great conversations where people are not talking about, like, let's wait for the market to turn around and all this stuff. It's actually conversations that are, like, hopefully will lead to, like, the right outcome.
Yeah, piggybacking off of what was just said, I mean, what you probably read about as things were starting to cool a bit in the market was that the earliest stage financing climate was going to be the last to slow down. And that was really true. And that happened really Q4 of last year. Finally, sort of the new term sheet, clean vanilla term sheets were drying up. But what people weren't talking about was the fact that I think that the earliest stage investing was also the first to pick back up. And I started seeing that really in the beginning of Q1. I think investors spent a lot of time as the environment tightened, caring for their darling portfolio companies, right? I mean, it was an absolute bloodbath in the boardrooms, trying to figure out how do you cut costs, how do you extend runway, insider rounds, and then what ended up happening is, I think what we're seeing now is, those startups continue to face challenges, but there is absolutely a balancing happening. And now I think investors are concerned about raising their next fund and putting capital to work and finding new emerging companies. And I would say in the last 3 months, I haven't founded as many companies or helped founders of new companies incorporate as I have, in the last 5 years. And I think that's a testament to what's happening with technology.
Interesting. And, one other data point to share with you all, and forgive me if you know this, but investors, VC firms, and Ellen can speak to this firsthand, like, they can't sit on capital forever. You have this dry powder. You do have to deploy that capital. I mean, you've made a fiduciary commitment to your LPs to deploy that capital. And so, I think a lot of folks have been feeling optimistic, as things are picking back up, that like pace is going to continue increasing, because there is still a decent amount of dry powder that VC firms are sitting on that they do need to deploy within a certain amount of time. So, I think that is another data point to keep in mind that gives me a feeling of optimism. I hope gives you a feeling of optimism as well. Ellen, oh, yes, of course.
I know the Fed, the Fed high interest rates, that's also impacted. They're saying they're going to be lowering it. Is there a certain rate where it really?
Great question. The way I tend to think about this when it comes to startups vis-a-vis interest rates is actually like more on the upstream side. And, I'm curious about your perspective here. And actually, Mike, you probably have insight here as well. But, with interest rates being higher, all of a sudden, for LPs who are thinking about investing into VC firms, like those investments into funds is less appealing. They can get really attractive returns without much risk, by foregoing coming in as an LP into a fund. So I think that the ramifications of interest rates are sort of happen further down the road because it impacts LP decisions, which then impacts VC firms, which then impacts their investment decisions. The rates being what they are currently, I think is having a bit more of an impact. And in all my conversations with investors, it's having a bit more of an impact on, the folks who are trying to raise fund 3, let's say. And oftentimes, the investors I speak with are like, well, we had hoped to raise a $200 million fund 3, and now we're going to do, a $100 million, whatever. Like they're sort of changing their expectations. But what are you guys seeing on that side?
I can't wait to hear Ellen's response. But I mean, I play in the earliest stage of the tech ecosystem, and when investors are coming in, first institutional checks, or or even in a round, that's a long-term bet, right? I mean, that's in some cases 7 years, right? So. I think that's why you saw early stage investing be the last to be affected and the first to pick back up, is because, this is what we do. I mean, innovation's going to be innovation. It's not going to stop. And so you want to continue to invest in it. But Ellen probably has a really nice viewpoint on that.
Totally agree. The way we always talk about it is the best founders are going to start their company no matter what the macro is. They see a pain that's missing in the market. They feel that internal urgency to go solve that problem. And so it might be that we see fewer opportunities in cycles that are a little bit slower, but the founders for those opportunities are extremely high quality. Sometimes when you get a little bit of an easier market, maybe you see more people who are excited about trying out a startup, but I think you see great high quality companies during tough macro times.
I think from the startup perspective, there are some founders that will get super excited about valuation and will drive a hard bargain on valuation, which sometimes sets them up for future problems, because what sounded like a great valuation, all of a sudden the next round sounds like a down round, which you never want to have. So you'll have it like if you need it, but in general, like you want to like make sure that you're setting your expectations, your valuations in a way that's like a little bit like less about like market timing and more about like the value that you're providing at a certain stage. And when dollars were pouring in, like a few years ago, like valuations like went a little bit like too fast, and value like once you get like a lot of money in the bank, you start spending it. And then Michael was talking about like how boards had to have conversations about like reducing that the burn that you have. So I think like now we're like getting close to like not an equilibrium, but like more of a sane market where like there's fundamentals there, there's some valuation, and then you're just focusing on like what you're building, what value you're providing, what problems you're solving.
Great point. I certainly am like keeping an eye on the interest rate topic, especially because, I think so many of the folks in the room are very early stage, but hopefully, presumably all of you will have great rounds and build your way towards a growth stage company. I think that's where we may see more ramifications sooner than in the really early stage world. So Ellen alluded to this already around metrics. So thinking about fundraising, there are, of course, certain things that founders can do to put themselves on the strongest possible footing going into a raise. And, of course, it varies by stage. The things that investors are looking for, when it comes to a pre-seed round are very different than the things they're looking for at a Series A, which is very different than the things they're looking for at a Series C. So this, of course, varies a lot by the stage a company is at. But let's, for the purposes of this topic, think about this through the lens of early stage, i.e., even as early as like friends and family or an angel round, as well as pre-seed and seed. And Ellen, I would love to start with you, since you did touch on metrics already. What do you think a founder can and should prioritize and or highlight in their investor pitch deck when they are trying to get an investor excited about their company?
Yeah, so I think this is, again, it's going to be vary by stage, which we already constrained, but this also varies by sector. And so for the types of investments we make at BoldStart, which are primarily enterprise companies, oftentimes those deals have very long sales cycles, take a long time to close. And so I'm not necessarily looking for people to come in and say, I have this much revenue or I have this many users or have a specific number. I'm really looking for a founder to understand the large market that they are going towards in the long run. And I don't need a TAM calculation or a SAM or a SOM or any of that. I just need to be able to look at it and go, yeah, if you can pull that off, that's huge. That's going to be a big company. And so proxies I use for that are like, oh, what's going to get this business to the place where it'll make $100 million a year? What would get this business to the place where it's going to acquire the current market leader in the space? But just something that lets me believe it's a very large market. And then after I'm sure there's a large market there, I spend a lot more time with the founder thinking about their clarity to the approach to the first thing they're going to prove. I think of each subsequent round of financing are you're proving that you de-risked something. And so I want a founder to come in and say, hey, with this capital, we're going to build this first version of the product. That version of the product, we're going to get it in the hands of 3 design partners. These are the 3 design partners we've identified as potential good fits. Here's one that I have a personal relationship with where I know the buyer. And so the more clarity a founder has around who is their champion within that organization, what pain and like what usage they expect once they're within that enterprise, the more convicted I can get on getting to an investment.
Love it. And Mike, you touched on the number of transactions that you've been involved with over the past year. What have some of the commonalities been in terms of those who are like finding that they're raising or even exceeding the amount that they hope to raise?
Yeah, I mean, listen, what I'll say is, it's at this stage, it's really a bet on people, and I think Alan will attest to that, and Richard. He's a repeat entrepreneur. Not everyone in this room or on the live cast has that benefit, but it's really a bet on certain characteristics around that person, because I think at the end of the day, whatever you conceive your business to be at present moment is probably not what it's going to be at scale, right? And there's going to be pivots along the way. That's one of the biggest pieces of feedback from my experiences is like the most successful entrepreneurs are the ones who really have that grit, and so I would say investors can sniff that out, right? So your conviction and commitment to your business, your characteristics, who you are, your background, and it's those softer intangibles that I'm seeing for sort of the earliest stage investings. I mean, the sort of the new investment from investors into entrepreneurs.
Awesome. Thank you. And Richard, you have had some really terrific momentum around your fundraising processes. What do you think it was that allowed you to go into those conversations so strong? Like, what were some of the, team attributes or metrics or momentum signals that put you on such strong footing?
I think at least like the investors that we're excited about, they do a mapping between the entrepreneur, the founders, the co-founders, and the market. What is that fit? Like if they see a great fit between like what problem that they want to solve with like the capability and the background of these founders, then they're excited about this because it's part of the Ellen's point, which is de-risking. Like you want to de-risk different things. If you're a founder that is trying to go into a market that you have no history with, and it's much harder because like you're going to be like doing a lot of like learning before you actually like tackle the problem. That's one thing. The other, like I've uh, I've had many years in products, and that's my co-founding team is like really strong, and it's been great to like have such a co-founding team, because partly we get inbound from people that we know from our network as well. Like that's always helpful, because like there's somebody that has kind of given a kind of nudge in terms of this person is somebody that I trust can solve a problem and can like has the grit to actually do the work.
Yeah. I love that you use the word grit there. I speak with probably dozens of investors every single week, and that word comes up a lot, as does the word traction metrics. And I want to just like touch on this for a second, because one of the things that I hear over and over and over again from almost every investor I talk to is the importance of having traction metrics as part of your pitch. As Ellen touched on, like sometimes companies are able to raise money successfully, even pre-revenue. Like there are many amazing pre-revenue companies that raise money successfully. I'd say generally speaking, having some revenue, any non-zero amount of revenue is almost infinitely better than having zero revenue. Because I think it shows, coming back to grit, like it shows that you are laser focused, that you have the grit required to go out there and like earn dollar number one, and then go out there and hopefully like earn dollar number two. Because again, like de-risking is such a great way of putting it as well. Like if you have been able to earn dollar number one, like that automatically de-risks the whole area of the business. Like, do you have product market fit? Do you understand your ICP, your ideal customer profile? So those signals, especially around revenue metrics, are super important to most investors at this moment in time in particular. That said, even if you are pre-revenue, especially if you're in certain domains where it's harder to get to revenue, if you are in biotech or pharma, like you're not going to get to revenue for a long time. Oftentimes, if you're in tough tech, if you're building a rocket ship, like the sort of cogs required to sell your first deal, like that's going to take a while. And yet, there are some leading indicators that are still worth thinking about for your business. And some of those leading indicators, even if you are pre-revenue, might be a wait list. It might be letters of intent that you have with prospective buyers. To Ellen's point, it varies a lot by industry. But, from my perspective, having those indicators, traction metrics like revenue, or even the leading indicators that show, visibility to revenue, really help put startups on the strongest possible footing.
To add one nuance to that, I would say if you have your option between a strong metric for pre-revenue or a $1 of revenue, I might take the former. Because you want to always think about what an investor is going to be comparing you to and how they're going to be thinking about the number that you give them. And so you don't want just the number, you want the story around the traction and how that's proven the right thing for you. And so if you come to me and say like, oh, I made $20, I'm going to be like, why are they telling me this? Like, that's not like an exciting enough number. Whereas if you're like, I didn't know if anyone would buy this, and I went to 20 individual developers and I got all of them to agree to an entire year subscription, like that's a much more exciting story. And so I would think of the number very much in the context.
Yeah, you're so right. I mean, I think we all love, we all respond and react to stories, and sort of the story behind your process as a founder makes such a huge difference when it comes to de-risking a potential investment. So let's talk about the flip side about this, about the red flags or the orange flags that can prompt a fundraise to stall out. And specifically, I want to dig into your perspectives on the liabilities that might exist when it comes to due diligence, the liabilities that might exist when it comes to cap table. And forgive me if this is common knowledge in the room, but in case there are first-time founders or aspiring founders who are less familiar with these terms, your cap table or capitalization table is where you are documenting everybody who has an ownership stake in the company. This might be your founding team. This might be your early hires. If you have investors, they will be on there. If you are giving options grants to an advisor, let's say, those people will be on there. And the sort of corollary piece is your data room. And your data room is the repository of all of the documentation that backs up your cap table, i.e. the documentation on your options grants, but maybe also your IP, anything else. Maybe if you have contracts with customers, your contracts belong in there. And the reason these things matter so much is because when you are in a conversation with an investor like Ellen, she will at some point probably want to take a look at your data room and or your cap table. When you are then going through due diligence and there is an attorney involved, someone like Mike who is digging through things, Mike wants to see that your cap table is squeaky clean, that everything is really complete and accurate. For what it's worth, like this is the sort of reason of being for Fidelity Private Shares. Like we want this to be absolutely foolproof so that you don't have to think about it at all and you can just focus on running your company. But essentially, having errors in that cap table, having anything that's incomplete can be a risk when it comes to raising money and having conversations with investors, but also going through due diligence. So, Mike, I would love to get your perspective on this. What are some of the errors or liabilities or issues that you see crop up when it comes to cap tables, data room, that sort of due diligence process?
Yeah, I mean, it starts with the paperwork that you've executed with individuals who have received equity in your business. And I would say there's two natural points where I enter into a relationship with a startup. One is prior to incorporation. Hey, Mike, can you incorporate our business? We have 3 co-founders and we'd like to get each of them a certain amount of equity. The other is, hey, we were using my uncle's brother's sister for, they're a lawyer, but they don't do this. And, we incorporate as an LLC and, our documents are a mess. Can you fix this? I'd say the amount of headache and cost that is associated with doing things the wrong way from out of the gate is so unbelievably material and detrimental to startups that it's the first place where you can make a mistake as a founder, really. And there are very few things that I can't fix, but it's going to be costly, even at my rate, or an attorney who knows what they're doing. So I would say, don't rush to document things with someone who's not, sophisticated in how they should be documented.
That's a great point.
So there's a couple of horror stories I've heard where initially the co-founders just gave themselves the stock without any 4-year vesting and all this stuff, and then one of the co-founders decided to leave, and then that was messy. For us, we my previous company, we had a lot of convertible notes at different price points. That actually cost us a lot of money in terms of financial and legal fees to get the numbers straight. It just extended the time to close at my previous startup. So these are things that are important. I think an investor, and Ellen will correct me if I'm wrong, will get really concerned if they don't see that your team is not getting much stock and much out of an ESOP because so you're keeping all the stock and this for yourself. So what is the skin in the game for the team?
Yeah, I agree with everything that has been said so far. I think the fundamental thing is, as a VC, you don't want a founder to be spending all of their time kind of thinking about this logistical overhead that there are great people like Kristen and Mike who can help with. They're people who spend their entire time specializing in this. We want you to be focused on building the business, and we want kind of everything around the cap table and data room to just be as stock as possible and let what you're actually doing shine. And from that standpoint, there's like just a lot of things that are standard. Like we expect you to come in with the Delaware C Corp the majority of the time. We expect founders, you can have different splits between founders. Most investors have their own opinion on that, but with 4-year vesting. We expect an option pool, and some people will push it down and say, I can do it on 10. Some people will say it's 20%, but we expect a pretty standard sized option pool, or we'll write that into a term sheet. Employee equity tends to fall within the same ranges. Like you don't want people to not be granting equity to early employees, but you also don't want to see people handing out 10% of their company willy-nilly. That's not going to last very long or be sustainable for anyone. And I think I probably missed a bunch of the things like that, but those are things that you can go to a lawyer, go to someone who's a great person in the community and find out. And then it's also important to have someone who's there to help you with the details. I actually worked with a company recently where one of the angel investment safes just didn't end up in the cap table, and we were working from the cap table as a source of truth for a future round. And it was kind of a pain when we had to go back through and readjust everything to handle that. This is also stuff where investors don't necessarily expect you to be an expert. So we like when people come in prepared and have worked with the right people, but we're also there to help. So like internally, we have an associate, Ernest, and when we have companies who are thinking about raising future rounds of financing, he can help model that out so they understand the dilution and the trade-offs and what they're putting together in the future. The last one I would touch on is the advisor piece. We also expect when there's advisor equity, same thing. It's usually also earned over time, invested the same way employee equity would be, and it's usually within kind of a set range. And so there's just a whole bunch of standard things that if you go to the right person and talk to about them, you'll end up at the right answers.
I love it.
I think there's a
Yeah.
question at the.
Hi, thank you for your remarks. I have a question regarding bootstrapping as well as patents. So when you have an innovator that comes to you and they have a patent out on a new or pending patent out on a new software, how important it is that they receive that patent prior to coming to you, and then if an individual, in terms of putting skin in the game, has painstakingly had to take some money out of their IRA in order to help fund the costs of the creation of the venture. How does it work around that? And I'm assuming the transparency needs to be right up front, and you want to know those dollars, and at what point should, a founder, if they have, perhaps one other individual, maybe it's friends and family who's helping them with the bootstrapping, but at what point, should a founder say, okay, this is when you're close to going to market, like, if you could just provide some feedback on that, I'd appreciate it.
Yeah,
Thank you.
I'll weigh in. Thanks. I'll weigh in really quickly. Just in terms of crediting yourself for putting money into the business, I think you have 3 options. One is not credit yourself, right? And I think people who are independently wealthy just say, "Hey, I'm going to put some money into this and get this thing moving." Not very likely. The other is to just do a straight note, right? Which is essentially an IOU that at some point in time, most likely the financing, you're going to get repaid. And pluses and minuses for that. Biggest minus being Ellen's not going to be super stoked if she's at the finish line to invest into a business and she realizes that half of her $500,000 is going to repay the founder. Or you do a convertible note, which, or a safe. And, the problem there is it creates some real conflicts, right? You're setting the terms. Unless you have a round open, you're going to be deciding what valuation you invest in. So there's no real great answer there. But you should work with someone who knows how to structure these things. That's most important. Second of all, on the patent thing, and I'd love to hear Ellen's take on this, but patenting software is nearly impossible. Not impossible, but very unlikely. Out of the 60 to 80 companies that I work with that get funding every year, probably 95% don't have a patent. I realize that that's not applicable to everybody out there. But, from my perspective, I think it's sort of a race to capture market as opposed to protection from the USPTO.
I agree with that. The majority of founders I'm talking to aren't necessarily thinking about IP concerns this early in the business. There's obviously exceptions, but on the software side, people are usually much more heads down on, I'm getting something built, and this is like the traction metrics that Kristen was talking about before. We spend a lot more time on what is the traction and the adoption, how is the go-to-market going to work, than we do on how would we defend the technology.
Can I swing back to, this is actually a great segue back to what we were talking about. One of the critical mistakes founders of businesses make is they aren't getting IP assignments from every single service provider that's touching their business. And that's going to be a huge diligence hole. The other thing I'll say is, when it comes to holes in IP or, wrong cap tables, what are we really defending against? And why do investors really care? Obviously, other than just getting it right, when you are at the finish line of selling your business, the acquirer and their counsel are going to, they're going to rake you over the coals. Okay. So, if there are any holes in your capitalization, in your IP, you may lose value at the finish line. Okay. And I see that happen all the time. And it creates some real headaches and issues. The final thing I want to say, and a little bit of a plug, and no one's paying me to say this, you guys don't know how lucky you are that Fidelity's platform exists. This wasn't an option for founders in the past. What can you get on this platform? You can get all the documents that have been developed by big law firms that all you need to do is answer a few questions and you get it, spit back out to you. You are going to save thousands and thousands of dollars on lawyers. And why am I selling it? Because I don't want to do that work. Okay? I don't want to fix your mistakes. I want to get a company that is going to grow. You're not paying my mortgage with your startup work. You're paying my mortgage with your financing work. So close. But go and explore these available software products out there that are going to help propel you and avoid spending a lot of money on lawyers out of the gate.
For patents, I think like the one thing that like helped us close the acquisition of my previous startup was a number of patent applications that we had developed over the years that as the acquiring company was excited about that patent portfolio. But you should never wait on the patent granting because we'll all have a lot more gray hair by the time we get the patent granted. There's a number of questions.
I have a question. It's kind of a concrete example. So our company has moved very quickly to try to position ourselves for seed investment. So we're registered in Delaware as a C Corp. We registered 10 million shares with the company. There were 3 co-founders at one time. 2 of us are still on it and working very hard. And yesterday we had our first meeting with an investor, and it went supremely well. But the 3rd co-founder had to resign because of financial need. He was in between jobs, had been working with us, but then indicated he was resigning because he took another job to meet his income needs. He had wife and kids to support. So he has indicated he's resigning. We've not yet updated our cap table. We have a cap table up on Angel List, and where we've allocated to ourselves, we've got a pool for investors and also future employees. What kind of risk are we facing there?
Do you have vesting on the shares?
No, we allocated a significant percentage to each of us. So in the co-founder agreement that this 3rd individual signed, he is having to forfeit his shares. That was written into the agreement, and he understood that. So, are we still at major risk?
Yeah, I mean, even in a resignation context, I think the name of the game is telling a story and being able to show a paperwork trail to someone like Ellen. So when you're going through diligence, when you say there's no risk that they're going to come back and claim that they own 1/3 of the company, you can show them a piece of paper that says that, right?
Yeah.
And so I would say get involved in work with a specialist to identify what you need, and I would negotiate that deal now before you get financing.
I would negotiate it now, and I would get some sort of separation agreement.
Yeah,
and like a
I have
certificate
his
of
email
inventions.
indicating he was officially
No,
resigning.
I would get a legal separation agreement. It's another
Okay.
thing a law firm can help with, and I would change your structure such that you and your other co-founder are vesting.
Okay, so not vesting is an issue.
Not vesting is a huge issue. Every company, 4-year vesting, 1-year cliff, 148.
We had the 1-year cliff in the co-founders
Yeah.
agreements, but, okay.
Awesome.
Thank you.
You guys have been so interesting and given such great information. We have 3 questions from the folks watching online. The first one is, what if I'm still in development but have created hypothetical models based on recurring costs, revenue, and MAU? Example, at 100,000 users with a ratio of 200 to 1, free user paying subscriber equals 65% profit margin and yearly revenue at 500K. Is that a metric investors would be interested in, or should I focus more on the vision and market study and building a pitch deck?
I would say if you're going to use a model like that, the key is to think about what are the things you're really trying to show in that model and how can you start to prove them out already. And so an assumption of, I think it was 100,000 users in there, like an assumption of getting to 100,000 users, that's a lot of users. And so I'm not just going to believe off the cuff that you're going to get to 100,000 users eventually. And so I would probably go more towards the story and sort of have that as backup if someone asks for it. But I would definitely think about the model more as like, what are the proof points that are embedded within this model that I would discuss individually.
One other thing I might add on that is, a great investor pitch deck usually has an appendix, and that's where you want to drop everything that could possibly come up as a question, so that you can really focus on the story. I mean, especially in the early stages, to Ellen's point, like the story matters so much. So make sure that your story is allowed to take front and center, and you're not like losing people in, slightly complicated math equation, but have that slightly complicated math equation and that model in your appendix so that you can talk through it if and when that question comes up.
I've run a consumer business in the past, and getting to 100,000 users is tricky. Your CAC, your acquisition costs are like there's no model because you haven't actually tried to scale. So there's a lot, like the investor will have to like believe a lot of the numbers that frankly don't have a lot of basis to them.
Okay, next question. If you like a company to invest in, will a cap table that is messy prevent you from proposing a term sheet which can clean up the cap table?
I think it depends on the type of messy. If you were to say have an outstanding co-founder with a major chunk of equity with an unresolved dispute, that's a huge existential risk to the company. And so that's definitely something that would need to be resolved. If we're talking about something on the line item of, oh, we did convertibles and we have this one small angel and that didn't get updated in the cap table and we figured out in the process, I would be like, oh, we should pay more attention to those details. But like that wouldn't necessarily torpedo a company I was really excited about. That's the sort of thing that like I would kind of go, oh, you should like talk to someone like Kristen and like we can get you better support to work on that type of thing.
And I just want to share a quote that like a friend said to me recently. It has stuck with me clearly. And I keep finding myself thinking about this. Lily Lyman from Underscore recently said this phrase. She was like, Kristen, the process is the proof. The process that a founder goes through when managing their cap table and data room. Like that is the proof of how organized they are going to be. That is the proof that they're not going to get the company into hot water. That is the proof that they're going to be open with me if something goes wrong. And that process is so, so important at the early stages because so often the investment decision hinges on like the team. There aren't necessarily other things to go by. And so just making sure, I think that sort of messiness is, as Ellen pointed out, like that doesn't make investment a foregone conclusion or fundraising a foregone conclusion. But I do think that like the process that you go through and that you were able to articulate about why it's messy if that question comes up, about show your process for how you are cleaning that up, how you are then making sure that everything is going to be squeaky clean from here on out, matters tremendously. So yes, the process is the proof. I hope that all sticks with you as much as it has stuck with me.
Fantastic. Okay, next question. Are traction metrics relevant to biotech early stage projects seeking funding? Is it true that de-risking the project or product idea is the same concept? If yes, is there a strong de-risk target for biotech fundraising in seed or A? I am, let's see here. It says, yes, I am moving a biotech startup to ask for money. Got grit, need money.
So correct me if I'm wrong, maybe Mike, you've done some work with some biotech companies, so perhaps you have a stance on this.
Yeah, although I would say, as a firm, we do work with biotech companies, but I'm more on the software side. So, I sort of defer to, I think this is more of a software group here.
Yeah. I work with a decent number of biotech founders, investors. I'm not an investor in biotech, so take this with a grain of salt. I think that in biotech is just such a different animal, especially if you're doing anything that requires like FDA approvals or trials. It is way harder to get to any kind of like traction metrics or even leading indicators because of the hurdles that exist, and sort of bureaucracy that exists. And I think like really the devil's in the details. Just one biotech company is just so different from another depending on what space they're in and what sort of like approvals and processes they have to go through. So I would say that traction metrics in general tend to be less of a topic that comes up when I'm in conversation with biotech founders and investors. Leading indicators that do come up more frequently, though, often are around like non-dilutive grants, i.e., has somebody else like done the due diligence on this, and do they believe in what you're doing so much that they are giving you this grant money? Perhaps those leading indicators might be pilots that you have run with MGH, let's say. Perhaps those leading indicators are the experts. If you are in cancer research and you have the foremost, expert on XYZ from MGH who has agreed to come on and as an advisor, like that is a really incredible testament to the type of company that you are building and the type of technology you have. So I would say like those are probably more so the leading indicators that I see come up among biotech investors.
Okay, we have time. There's no more questions from the virtual attendees. We have time for maybe 3 more questions. So start over here.
Thank you. Someone mentioned convertible notes at different prices. Would you mind digging into that and how you reconcile that? That might be useful for early stage.
So at the previous startup, when we did raise, we raised with a convertible note. Like there's a cap, and that's put in the convertible note, and then we raised additional funding like a few months later. So the cap has changed. It ends up being like messy in terms of like numbers, in terms of like running the numbers to figure out like what does it, like how many stocks does it does it actually turn into? So it just work to be done. The lawyers we worked with were not like very Excel friendly, so we had some, we were like correcting their Excel sheets a few times. It just like delays the process.
Issue, like it was numbers on a page issue. It wasn't like it wasn't like a red flag that you had.
No, but like it's so it converts. So each of those notes converts at a different price. So there's a bunch of like funny math you need to do to actually like be able to turn them into the actual number of stocks.
Long formula, but it's okay to have notes of different.
Yeah.
Yeah, but the only thing I would say there is, it could be a real investor relations issue if you are selling two different convertible notes at the same time, or you're keeping one round open with one valuation cap and selling to other people at a different valuation cap. Yeah, I had a client who ended up in litigation over that.
Great question.
Going back to the bootstrapping, if I'm doing a pre-seed round, and as a serial entrepreneur, I could put, say, 10% of the round, 20% of the round, say 200,000 out of 2 million. Should that be in the pitch deck? Is that going to make it worse, make it better? And if it's in the pitch deck, how would you put it in the slide?
I think it depends if you want to or not. From like the way I would think of this as a former founder, and I think as an investor now, sometimes people will finance themselves at the beginning. I would usually think they would do that at the beginning to get to like further traction metric for when they're raising institutional. I don't think I've ever seen a founder offering to put in at the same round as an institutional does. And I think that's often because, like, why would you be selling your equity if you want to buy it back? Why not just raise less and dilute yourself less?
Yes, my name is Eric. My company is Duber, and from the name you can guess what we deliver. But I am a part of a social equity program, and I was planning on raising money by getting the license and then approaching investors, and letting them know that, well, for 3 to 5 years, these delivery operator licenses are exclusively being disseminated through the social equity program. To apply for the license, you have to be enrolled in the program. Enrollment period comes about 2 months every 2 years or so. So it's the access to the licenses are fairly limited. I've submitted all my policy paperwork to the state, and that's been approved. So I'm pre-certified. But to get a provisional license, I have to secure a location. I've been working with a realtor. I found the location I want, and he sent me a lease, but then he started interrogating my funding sources. And I'd mentioned that once we get the provisional license, once I get that letter of intent, I can bring it to the town hall, set up a public meeting, take a recording of that public meeting, send it to the state. They send me a provisional license. I also have access to $50,000 in grant money. But my challenge is kind of circular now. My plan was to use the license to say, well, this is a limited license. If you invest here, we can start this delivery. But the challenge is, well, I'm running up against, the first realtor I came across said, I really like your plan, but I want to be your partner, and I want to be a 50% partner. So I had to walk away. But now I found a location, and I'm working with the realtor, but he's interrogating, how I'm getting funding. So I guess my question is, what for a person in this position, what's the best way to get in front of investors? Should I just use my phenomenal pitch deck and say I'm in a program, or should I really focus on getting that provisional license first and then just running around to the investors? The challenge being, once I sign that lease, I'm going to have, let's say we open up in January, I'm going to have, 3 months to raise everything over $50,000 that I would need to get started up. And that's probably another $300,000.
I'm working from limited context here, but from what you've described so far, it sounds like you're opening a business that will primarily have a retail outpost.
No,
and
cannabis
then have
delivery, just online storefront, buy wholesale, and I, just deliver straight to customers.
Okay. So I think there's still at least one thing I would bring up that I think Mike might have a better perspective on from having worked with more funds. I think a lot of venture funds have restrictions on the types of businesses they can invest in, and this might fall in that bucket for some funds. So I think you're going to need to specifically target investors who are comfortable in this market.
I've been targeting cannabis firms for investors.
I think that's going to be important.
I will say, I think anything that you can do to be closer to revenue will only benefit you. And so it sounds as though you right now are trying to go from this pre-license to having that license, the provisional license. again, like also limited context, but for what it's worth, it sounds as though that's an area where, if you can get that next step, all of a sudden, like you are that much closer to revenue ready, which makes you more appealing to investors. So I don't know, I can't help but find myself wonder, like, if you are running into problems with the location that you found, like, are there other options there that will let you check the box on the location so then you can get the license? And I will say, I know so many amazing startups as well as VC firms that have extra space and they're looking to have sort of sub tenants or sublessors on their space. And arguably, like, a really cool startup would probably be psyched to have you like working out of their same space and to help defray their own real estate costs. So maybe getting creative on that front could just like help you move forward on that piece, that then you just don't even have to answer the question when talking with investors. Like, well, why don't you have this license yet? So that's my thinking.
Brilliant. Thank you.
Earlier, the panel was talking about the view by investors of biotech, that it's a long haul. We're an generative AI startup. I'm wondering how do investors view the traction requirements for that? I mean, the technology is still new. We have software and MVP, and the few users we've been able to come and take a look at it have been ecstatic with what they see. But we don't have large numbers of users. It's an MVP. We're not billing for it yet. So I'm just curious, what kind of traction expectations are there within the generative AI space?
Yeah. So first of all, and forgive me if you know this already, but right now, the amount of money that the AI companies are raising is on average 30% higher than companies that are not leveraging AI. And I bring this up just because I do think it's a testament to like where the market is right now and where there's an appetite. Therefore, I think that oftentimes there is more flexibility when it comes to companies that are in the generative AI space, let's say, than, a software business that is not. I think oftentimes because things are moving so rapidly in AI, team is even more important. I mean, team is always important at the early stages, but even more so when it comes to, an industry that's evolving so rapidly. So, I think like the team and the team credentials matter a lot. Your advisors and advisor credentials matter a lot. And then, early indicators, again, if you're in conversation with people who want to pilot your product, that is a great data point to be able to share. If you, or even if you've conducted a pilot or you have LOIs with folks, like those are great leading indicators. But do any of you have other thoughts on?
Yeah, like I think this space is a little bit tricky. Like on one hand, you have like a lot of valuation, potential improvement, but on the other hand, like things are moving so fast that you have competition that you every investor has seen like 100 decks that look like yours, and that's a challenge. And a few months ago, like a lot of the money was going in infrastructure when it comes to generative AI. Very little money was going at the application layer. Things have changed now. Like people are like, oh, like infrastructure at the, for Gen AI is raised to the bottom. So you have to decide whether you have the patience to like explore like all these things and like constantly be able to pivot very quickly, like because like that's a space where you have like people that are excited. Why aren't you charging them? Like why wouldn't they be giving you like whatever that subscription or whatever model you have? So it's a space that's we're in that space as well. It's a very competitive space.
These are such great questions, and it's been so fun and awesome having such an engaged group of people. I think that some of us are able to stick around a little bit longer, but I also want to be respectful of time for those who do need to go. Huge thanks for being here. Huge thanks for having us, and would love to keep the conversation going with any of you. Thank you.
Thank you, panel. Okay, folks, just